Hi, everyone. This is Natalie Pace. Thank you for joining me today. We're going to be interviewing Ann Sonders. She is the SVP and Chief Investment Strategist of Charles Schwab and has been for decades. Also, she has been spot on for decades. She really is transparent. She's truthful. She's knowledgeable. She's data-driven, and she's very often right. So we'll be getting started in just a moment.
All right, and I already did my introduction. So let's start with the Nasdaq, because yesterday it was in correction territory. It's recovered a little bit, but does this weakness in January signal anything to you?
Well, it signals actually a little bit more of the same. It just is a bit more on the surface than the past year or so. But if you just look at 2021, where the Nasdaq at the index level had no more than 10% correction, it was concentrated in that March-April timeframe. More than 90% of the Nasdaq's members had at least a 10% correction last year. And by the way, the average maximum drawdown across all 3,000 or 3,500 Nasdaq stocks last year was more than 40%. So wow. We've had a tremendous amount of churn and rotations and weakness under the surface, but where there have been pockets of weakness, there's been offsetting pockets of strength. So it was masked by an index level decline that was more minimal. I think the fact that right out of the blocks, we're seeing it at the index level is maybe a little bit more jarring, but the under the surface stats are even more jarring. So clearly there is more weakness. What does it portend for the rest of the year? I think it's too soon to tell, but they're selling. The selling pressure is on.
And I mean, do we know who's selling? Is this mostly the large money, or it's not retail?
We don't necessarily know, but if you break the Nasdaq into deciles, and here's another stat: about 45% of the Nasdaq right now, the members are down at some point in the last 52 weeks, are down more than 50%. If you break the stocks into deciles based on market cap, the weakest decile by a pretty wide margin is the lowest decile of market cap. And by most definitions, those would be in the micro cap area.
Oh.
So that arguably has more of a retail day trader flavor to it, but you'd have to be really careful generalizing about that, because there's so much fast money, hot money that chases momentum in one direction or another, and that can blend into the institutional sphere as well.
Well, it sure does lead us right into meme stocks and the high levels of margin trading and the younger generation who's never known a correction yet, really.
No question about it. And I think for the most part, it's a good news story that for whatever reason, and I think it was exacerbated by the pandemic, the liquidity that was provided, the fact that when we were all in lockdown, there wasn't much else to do. Sports betting stopped. And then, I don't know, Schwab may have had a little something to do with zero commissions and making trading much easier. So it was a lot of ingredients in this recipe that generated just a tremendous amount of interest on the part of newer, younger, let's call them traders at this point. In a perfect world, we transition that cohort from being short-term day traders, not always focused on fundamentals or intrinsic value and all the things we grew up in this business learning about and have spent more time speculating down the quality spectrum. Hopefully, we meaning Schwab can certainly be part of this process, can through education and experience and learning and learning from our mistakes, transition that cohort into being really successful long-term investors. But there will probably be some pain along the way.
As there always is, if you aren't properly diversified and protected. And as you always encourage, rebalancing regularly. Do you want to talk a little bit about the value of that, which isn't, and I think you're really always keen to point out, this isn't jump in, jump out. It's simply, right. So let's talk a little bit about the rebalancing.
So even
maximize gain.
Even in I suppose there's never such thing as a normal market environment, but a market environment that is not so unique by virtue of being in a pandemic for 2 years and everything that has wrought, including these massive rotational corrections that we talked about in the context of the Nasdaq, but it's more than just the Nasdaq. In general, rebalancing is such a beautiful discipline for a couple of reasons. First of all, it's very distinctly different from all in, all out. Yeah. And the all in, all out approach, get in, get out, that's gambling. There's no other way to describe it. And it's gambling on a moment, or better put, 2 moments in time, the get out point in time and the get in point in time. I'm 35 years in this business. I would never suggest I have any greater edge on making calls like that than anybody else, and nobody does. In fact, the most successful investors in history, I would say they round to 100%, do not and have never taken that all in, all out approach to investing. And what's beautiful about rebalancing is your portfolio tells you when it's time to do something, tells you what to do, and it forces us to add low and trim high. And I was purposeful in the use of those terms versus buy low, sell high, because those terms might infer an all or nothing approach. And we don't have to rely on our own gut instincts or models that tell us when to get in or get out, or anybody else's. Your portfolio tells you when it's time to make that adjustment, and it forces that discipline. And I think in an environment like the past year or so, where you have this rapid fire sector volatility and rotations that are happening with different drivers and different leadership shifts in very short spans of time, one thing we've been suggesting is, if you can, and there's tax and turnover implications, but maybe consider, if you have solely rebalanced based on the calendar, you do it once a year, or maybe you do it quarterly, maybe have it be more portfolio driven. Have the sort of triggers be, all right, well, I've really gotten out of whack, whether it's in a particular security or a sector or even an asset class. And maybe it's time to take some profits where profits are handed to you and add into where there's been weakness. And it's just a better way to stay in gear than the timing game, which nobody plays well and wins consistently.
That's a very good point. Thank you for clarifying that too. Add low, trim high. Sure. It's a good one. I love it. All right, so let's talk a little bit. So you kind of inferred that there's really no way to have a crystal ball on what's going to happen in 2022. But what are some of the data points that you're seeing? Like, are there any suggestions that we might be near a top, or is it kind of conflicting data? I mean, here on one hand, we've got, CapEx, and we've got a lot of cash in the businesses, and we also have a lot of debt. Equities are high, but they kind of do these wild churns where they get to be in buying range again. Go ahead.
As has often been said, and I wish I could credit the person, I'm sure there was somebody who first said it, but as has often been said, market tops are processes over time. Market bottoms tend to be a bit more about moments in time. And so tops don't tend to be sort of this crescendo. They certainly don't have the bell that gets rung, giving us a clear sign that, okay, the bottom is about to fall out. And quite frankly, you can have a corrective process, even a bear market process, without index level declines that are akin to that. That's exactly what I talked about with 90%, even in the case of the S&P last year. I think it was 93% of the S&P last year had at least a 10% drawdown at some point in the year, and the average across all 500 stocks was 19%. That's almost a bear market. Amazing. It just happened through a process of rotation, keeping the index level decline to no more than 5.2%, but a lot of weakness under the surface. So sometimes you can go through, it's not really even a topping process, but a corrective phase where you ease either sentiment excess or valuation excess through rotational corrections. And I think probably most investors would choose an environment like that than, say, having the Nasdaq drop 40% all at one time. So that could persist. We could have that underlying makeup be significant churn under the surface, but I wouldn't bet against the indexes playing a little more catch down to some of the underlying weakness in the market. And I think the primary force at play, leaving aside the virus and Omicron, is the shift in Fed policy. And that is typically the most important inflection point for economies, for markets, is when you go from very easy monetary policy on the way to tight monetary policy, which of course has steps along the way from really easy to less easy to getting tighter to more tight to tight. And we're clearly in the beginning of that process. And that always has implications for the market and almost always ushers in some volatility, even if it doesn't automatically mean an imminent corrective phase in the market. But I think that's the most important force with which the market is grappling right now, is that change in monetary policy.
That and maybe a slightly slower GDP next year. I mean, this year as well from last year. But also what I think is interesting, one of your colleagues had pointed out that the yield versus bond versus stocks, when the yield is under 5%, it can be positive rather than negative, but above 5%, of course, everybody flies to safety. But any comments on stocks versus bonds? I mean, I think we also have to look at how much leverage there is too, right? And the negative yields in the bonds.
Now, I do think a lot of the leverage in the corporate sphere, leaving aside the lower quality companies in the kind of junk space, I think a lot of the leverage actually was somewhat rational decision making on the part of corporations to take advantage of very low borrowing costs to just fund operations, fund capital spending in an environment where they might have otherwise, drew on existing lines, or they might have come to the capital markets for raising money. So I don't view this as sort of this epic debt bomb about to explode, akin to what happened tied into the mortgage market, obviously in 2008. But certainly for those companies on the lower quality end of the spectrum, to the extent we start to see spreads moving up and some of that refinancing pain becoming more acute for the lower quality companies, especially the zombie companies, that's certainly a potential risk down the road. I think when it comes to the relationship between yields and stocks, level can certainly matter, but I think what's more important is direction and whether you're actually shifting into a different secular environment for what tends to drive the bond market, which is not just growth, but obviously inflation. And I think what is really key to watch in the near term is not just yields and stocks, but the correlation between bond yields and stock prices, because you tend to go in really, really long cycles. And those cycles are defined as a long secular cycle where it was more of an inflationary backdrop versus more of a disinflationary backdrop. So if you go from the mid-1960s all the way to the mid to late 1990s, so 3+ decades, with very few exceptions, bond yields and stock prices were negatively correlated. So generally when bond yields would go up, stock prices would go down, and vice versa. What characterized that era was more of an inflationary backdrop, which meant that generally when yields were rising, it was because inflation risk was increasing. And certainly in the case of the 70s, it was also an environment where economic growth was weak. That's a terrible recipe for the stock market. Fast forward to the late 90s through to basically a year ago, that correlation was positive. And it was almost always positive with a couple of minor exceptions. And that's because we were in more of a disinflationary backdrop. So in that environment, when yields were going up, more often than not, it was a message about the economy getting better without the worry about inflation. That's a great backdrop for equities. Last year, the second half of the year, summertime-ish, we dropped back down into negative correlation. we didn't stay there. It popped back up.
Right.
But to me, that is key to watch. Not so much because it has implications for how we think about bonds and stocks in our portfolios,
Right.
but could help to answer that question. Is this just a COVID-related, not transitory, but short-term phenomenon of inflation, or are we actually transitioning from more of a disinflationary backdrop in a secular sense to more of an inflationary backdrop? And I think if there's one quantitative metric that might help answer that question, it's that bond yield stock prices correlation. If we were to move back into negative territory and stay there, I think that would be a pretty glaring message that the backdrop has changed. We're not there yet, though.
So let's talk a bit about inflation, because we've got bottlenecks, we've got workers that are getting more negotiating power. We do have a few things in here, and as with the economy in the 21st century, it has been disinflationary. What do you think? I mean, I know it's difficult to predict, but if we do you see us cycling through the bottlenecks? Do you see maybe the labor force, not being as strong in terms of negotiating tactics?
So I think that in terms of the bottlenecks, in terms of the very COVID specific pillars under this inflation genie that's come out of the bottle in the past year, I think those will eventually ease. In fact, there are some leading indicators even now that are already suggesting by year end, we could see a much lower year-over-year rate of inflation, whether it's CPI or PPI or PCE. A couple of those would be, if you look at ISM new orders, which is a very well-watched leading indicator in general and broadly in any time, any cycle. But the ratio of new orders to both production and inventories have both rolled over significantly. And they're very highly correlated leading indicators of inflation pressures. We also have the reverse base effects. Part of why, when inflation first erupted last year, the numbers jumped so quickly into pretty eye-popping territory was because the comparison in the early months of the inflation surge was against 2020, when we were in shutdown mode and we went into COVID deflation. So the year-over-year numbers were massive. Well, the reverse will kick in within several months, certainly the latter part of the year, where the comps will be against last year. So that year-over-year rate will decline. And in terms of the labor market, I think this is more a story about profit margins. I think that's what's more valuable to focus on. I don't think we're sowing the seeds of the 70s style wage price spiral of inflation. There's still a lot of dispersion in wage increases. The good news is, if number one, you should always look at median wage growth, not just something like average hourly earnings, because an average gets wildly skewed, especially in this era, by mix shift. So if you looked at average hourly earnings, April of 2020, in that month, average hourly earnings were up 8.3%. Nobody thought in a month where I think we lost more than 20 million jobs that wages were on fire. It's just most of the job losses were concentrated on the lower wage end of the spectrum. So you take a bunch of lower numbers out of an average, the average goes up. And the complete opposite happened when we had many of those months where we had unbelievably strong job gains. Those were on the lower end of the spectrum. So you saw a complete boomerang and you went down into depressed wage growth territory. So median measures are more relevant to look at. And Atlanta Fed has one called Wage Tracker, and they do some interesting things with breaking out wage growth. And this helps to explain this dispersion idea, that this is not systemic. It's not across the board. It's not happening everywhere on a spiral kind of basis. In fact, if you just do the highest income cohort versus the lowest income cohort, the wage gain is not only the highest for the lower income cohort, it's high and positive, whereas actually the higher income cohort, I forget whether they do it in quintiles or deciles, is actually in negative territory. So that's good news in the sense it doesn't solve the wealth divide, the income divide, but it's at least a start. And you can also look at job stayers versus job leavers. they also split it that way. And with overall wage growth, median wage growth at about 4.5%, it's about 5.5% for job leavers. It's only about 3.5% for job stayers, which ties into why the quits rate has been so high and why we now have this cute term of the Great Resignation, because the incentive is there. But I don't necessarily think we can extrapolate that as a permanent thing year after year after year. I think the conditions that brewed that in the 70s, there are just more differences between now and the 70s than there are similarities.
Do you think that the Feds are going to be able to negotiate a soft landing? I mean, they certainly have been improving their correspondence, and they're, letting us know. I mean, it seems pretty clear that, what did you say, 2 rate hikes, maybe June and September?
Well, actually, the market now has 4 priced in.
Really?
And that's somewhat recent, yeah. Now that can change, and the market, the Fed funds future market can change on a day-to-day basis. So that's not, etched on a tablet anywhere, but we recently jumped to, I think, 4.2 if you do the extrapolation of what those markets are saying. But the real answer is we don't know. And I think when I get the question a lot from people about is the market right? What's the Fed actually going to do? There's almost this underlying suggestion that some people think the Fed sort of has their roadmap and they're just deciding when to telegraph it to us, lowly market watchers. They talk very forcefully, rightly so, about being data dependent, and they are, and that's what will be the decision points in terms of is 4 accurate? Is it 3? Is it something more? And ultimately, it's the pace at which the Fed moves that has been a greater definer of how the stock market has behaved, at least based on the past. The one caveat to all of this is COVID, number one, and COVID being a driver of the inflation problem that the Fed is trying to combat. They concede, rightly so, that there's only so much they can do. They can't solve the semiconductor shortage. They can't bring more natural gas supplies to the UK. I mean, the list goes on and on. So that is different this time. And we've got the balance sheet aspect of Fed policy too. And when you look at history, you can look at a long history of rate hike cycles, but you only have one prior sample size in terms of the balance sheet and taking rates to 0 and ramping up the balance sheet with QE and then going through QT. And that was the 08 and the aftermath of that. So we know it's an additional factor, an additional tool, and we only have the financial crisis as a proxy. And that was such a different crisis that I'd be really careful about, establishing the parallels there. But this is not just about rate hikes. It's about the balance sheet as well.
Well, I mean, the balance sheet is crazy high, right? Isn't it 8 trillion?
8 trillion,
plus?
Yep.
And
I think that's one of the things that's rattled markets very recently. When Powell came out and announced that the pace of tapering would be increased relative to what was announced in November, some people called that a pivot and it was a surprise. I didn't think that was a surprise at all. I think it was very implicit when you announce tapering, but you very explicitly say, but the amount that we're announcing today is only for November and December. We'll then reassess. That to me, basically said it's a guarantee unless you see some weird complete reversal in the inflation data, they're going to up the pace of tapering. So the announcement of doing that, I was a surprise to some. We didn't think it should have been a surprise. However, in the minutes that came out, the detail that went into their discussions around not just tapering and ending tapering sooner, but actually starting to let the balance sheet shrink, quantitative tightening, that I think has been what has rattled markets, that they won't potentially have a long pause between the end of tapering and actually starting to shrink the balance sheet, that there may be a much narrower time frame there. And I think that's what the market's been digesting.
Let's talk a little bit about consumer spending and consumer sentiment. We are, as you rightly point out many times, consumer spending is so much a part of our GDP growth. And then you had that great chart from the University of Michigan, consumer sentiment. Do you want to talk a little bit about, even what's interesting about this is that the euphoric state of retail investors seems to still be high, but yet the pessimism is also there. So let's talk about all these factors. And do you think that the consumer can continue to spend as government programs are sunsetted?
I think you've already seen a significant waning in consumption and consumer demand, especially on the goods side of the economy, because that's where most of the consumption has been concentrated.
Yes.
And quite frankly, most, if not more than all, of the inflation pressure has been on the goods side of the economy. Actually, if you break a metric like CPI out into goods versus services, you're still in sort of deflation zone for services. So it's all plus the inflation is concentrated on the goods side. And if you look at some of the releases of various consumption data metrics, including things like retail sales, when expressed in nominal terms, they still look quite healthy. But most of that nominal increase is because prices have gone up. If you look at real trends in consumer spending, including retail sales, and even more broadly into the economy like industrial production, they have weakened quite substantially. So I think we're already seeing a lot of demand destruction, somewhat due to high prices. It was initially said by whomever said it about commodities, but we can think of it more broadly. You know, the cure for high prices is high prices. And in fact, it's part of the reason why, because you also asked about consumer sentiment, consumer confidence, and there's two different monthly measures, but they're basically measuring the same thing. Yeah. You get a headline reading on those, but you get, I think, just as much interesting detail with some of the sub questions that are asked in the survey. And some of them are around buying conditions or buying intentions. And the buying intentions or buying conditions, and each one has a different way of asking this similar type question, have basically imploded, where people are either saying my intention to buy, and it's more on the good side, whether it's, you know, a large household durable purchase or a home or a car, my intention to buy, or do I think the conditions are good, have imploded. And that, unless you see a complete rebound in the near term, that's usually a pretty accurate leading indicator. So I think we're seeing some demand destruction simply because high prices are pricing people out. They're a disincentive to doing something. It's sometimes called counter-cyclical inflation, where in the early stages of this inflation move, it was pro-cyclical inflation, which is when demand surges, which it surged for the unique reasons associated with the pandemic, but also because of the massive amount of stimulus. That caused a massive increase in prices. That's pro-cyclical inflation. Counter-cyclical inflation happens when prices get so high that in and of itself, that puts downward pressure on demand and on growth. And I think we're experiencing a bit of that now. So I think the bloom has already started to come off the rose as it relates to consumption, and the savings rate, which had gone up into the mid to high 20% range when we were in the throes of the receipt of the direct fiscal stimulus, that's back down to just a little above sort of normal levels. So I think this idea that there's just a massive amount of savings that can still come into consumption, I just question that, if at least you use the savings rate as a proxy for that. And then I think in terms of whether demand for services acts as an economic offset, tell me what the virus is going to do, and I could maybe better answer that question. But boy, if that's one area that continues to be at the mercy of the virus, it's the services side of our economy.
Yeah. And maybe even at the budgets. I mean, a lot of people are breaking the budget to try to buy these expensive homes. I mean, I've seen some unaffordability numbers that are just crazy. I mean, even in your area, especially.
Yeah, I mean, the good news is that this is not like what was going on in 2005 and 2006. Lending practices are not ridiculous. So yes, it is. They've had to change budgets and spend more than many would like to, and they're probably stretching themselves. But this is not a world of ninja loans and trillions of dollars of derivatives piled onto the leverage in the global financial system that ended up being a literal and figurative house of cards. But certainly housing. I mean, where I am in Naples, Florida, it's unlike anything I have ever seen, including the '05 to '07 period. It so blows that out of the water. But these are really, really wealthy people buying houses that might have been, $10 million a few years ago, and they're now paying $25 million. Same thing's happening in Palm Beach. I'm talking obviously at the higher end.
At the higher, yeah.
But that's where the appreciation is just so eye-popping. But it's cash buyers. So that doesn't mean we don't have kind of a bubble lowercase b in prices.
Right.
I just don't think it's the house of cards that takes down the entire global financial system. The one thing I would say, though, and this is more about the stock market, but I would tie real estate in as well. There's a valuation metric that is increasingly kind of in the spotlight, generic or in slang terms, sometimes called the Buffett model, because Warren Buffett has said many times it's his favorite valuation metric. And there's a couple different ways to do it, but basically, you take the entire market cap of the U.S. stock market. It's not an S&P metric, and divide it by the size of the U.S. economy. So it's basically market cap divided by GDP. Okay. That is way off the charts, way, way, way higher than any prior high, including circa 2000.
Really?
Now, that doesn't say, oh no, the market is set for an imminent crash. What it does say is that the market has never been more important to the economy than it is right now, which means that when, not if, when we get the next bear market, it probably will have a more outsized impact on the economy, even if the other drivers of the economy hang in there. Quite frankly, that's exactly what happened in 2001. We had a recession in 2001. It wasn't a very painful one. It was fairly mild. It was fairly short. And I don't think we would have had one at all were it not for the crash in the stock market. But the stock market had become so important in the economy that caused the recession less than a year later. And I think it's kind of a chicken and the egg thing. But given that market moves tend to predate economic moves, bear markets tend to start before recessions start. That's the leading indicator nature of the market. So if history repeats itself, that would suggest we get a bear market first. But I think it has the potential to have, in and of itself, an outsized impact on the economy than in a normal environment where the market has not become as big a driver of the economy.
That leads into one of the statistics that you quoted that I saw, and I think this is really important since you guys do cater to retail investors. You said 60% of households were 60% exposed to equities. So can you talk a little bit about what that statistic means and how people could perhaps get a healthier balance?
So yeah, it's actually about 62%. It's just about tied with the prior all-time high, which maybe no surprise was in early 2000. And it's not Schwab data based on households associated with our client base. This is quarterly flow of funds report that comes out by the Federal Reserve. That's where the calculation emanates from. And it does have a bit of a lag, but one of the best ways to think about a broad national metric like that is forward-looking, long-term prospective returns, not trying to put a number per se on it, but trying to get a sense of whether, say, subsequent 10-year returns are more likely to be above average or below average. And maybe no surprise, if you look at a chart of that metric of households' exposure to equities over time, and then you look at subsequent 10-year performance for the S&P 500, there's a perfect inverse relationship in the sense that it's a stair-step pattern. Yeah. So if you break household exposure to equities into quintiles based on history, the highest quintile of household exposure to equities has been followed by the lowest quintile in terms of stock market performance and vice versa. Now, the good news in terms of just throwing numbers on the data is the highest quintile of household exposure to equities, the subsequent 10-year return for the S&P on average is, I think, 2.8%. So that's not that's not Armageddon. We are talking about 10-year periods. It's very rare to
Right.
lose money in the market over a 10-year span. But clearly, a message about curb your enthusiasm if you think you're just going to keep repeating the kind of extreme returns we've seen on the upside. And it also reinforces that we need to be mindful of rebalancing. Part of the reason,
Exactly.
given that fund flows, especially ETF flows, didn't ramp until last year. Last year's fund flows into domestic equity ETFs. There was more money that went into equity ETFs last year than the combination of the 3 years prior. And prior to that, we were actually seeing net outflows really for years after the 2007 peak in the market.
Yeah.
And I would often get the question, well, then how can exposure be so high to equities? Well, if you don't rebalance and the US equity market continues to do well, especially relative to pretty much everything else, at the end of a long multi-year period where you haven't rebalanced, guess what becomes a bigger weight in your portfolio? The thing you didn't trim that has outperformed everything else. So it's sort of a lack of rebalancing more so than some massive surge of buying over a multi-year period of time, but it is what it is. That's where we are. And that there's nothing to suggest that we couldn't go higher. Maybe the next high, the next threshold goes well beyond where we were in 2000. Maybe we're at the beginning of this sort of new cult of equities. I don't know the answer to that. I don't think anybody needs to, because it doesn't have to be, oh no, is this a get in or get out moment? It should never be a get in or get out moment. And there's, taking profits via rebalancing. No one ever went broke taking profits. Or adding into weakness. The stock market is the only market I know where when things go on sale, people have no interest in buying them. Neiman Marcus has a 50% off sale. I'm in. I'm the first one at the door. But the stock market's a very different animal.
This is true. Well, I kind of wanted to end a little bit with some sectors. You had talked a little bit about maybe healthcare being something that you are overweighting, utilities underweighting mainly on valuation concerns. And I also would like you to comment briefly on CRE. Is there a secular shift in commercial real estate? What are you thinking about REITs and that sort of thing, specifically malls and office buildings?
So let me answer the second part of that first, because I do very little day-to-day analysis at the sector level and do none at the industry level, which would be that, level CRE. Down. Yeah. So we have REITs as a sector because it's fairly new as its own sector as of a couple of years ago, as neutral. But I don't personally, David Kastner, who's our sector analyst, will tend to dive a little bit more into the subsets. And of course, we have Schwab equity ratings where at the individual REIT or stock level, you can see ratings A, B, C, D, F, but we rate 3,000 stocks. And, I have a decent memory, but I don't have 3,000 stocks rating. So I can't say, well, here are the, 8 stocks that have an A rating within, the mall or so. That's up, what do they say, above my pay grade, but not my bailiwick. But here is the broader answer. Yes, we have one outperform right now, which is healthcare, one underperform, which is utilities. But actually, that doesn't really tell the full story. Although part of the reason why we only have one outperform and underperform is because we actually think investors want to take a more sector neutral approach. And one of my messages for quite some time now has been to be more factor focused than sector focused. I have a chart that I show on a regular basis, sometimes in written reports, sometimes I post it on Twitter. It looks at first blush like the typical asset class investing quilt. Everybody's seen it with the colorful boxes, and usually it's arrayed with broad asset classes, long bonds, large cap US stocks, emerging market stocks, treasury bills, commodities, and it's usually done year by year, and it ranks color coding best to worst. And the point of everybody that uses a visual like that is about diversification, and that asset classes move in and out of favor on a year by year basis. There's no pattern. You shouldn't try to pick up a pattern either by chasing what's at the top, or some people think, oh, maybe I just buy what's at the bottom. It just doesn't work. I did a take on this starting about a year ago, where I did sectors, all 11 sectors. And instead of going year by year, I went month by month. And you would not believe how all over the page all the colors are. In fact, one example, last year, energy was the best performing sector in 2021 by a pretty wide margin over the number 2, which I think was financials. But energy ranked the very bottom in more months than it ranked at the very top. It was either at the top or at the bottom, or close to the top or close to the bottom, with just like ongoing
Crazy.
W's the whole way. And even a more staid sector like utilities jumped all over the place too. Trying to figure out that in advance of it happening, there's no way you can do it.
Yeah.
No way you can do it. What has been more consistent is factor outperformance. In fact, with all this discussion about growth versus value, I don't think about growth and value in the traditional way. There are indexes of growth and value, but that doesn't often tell you about what's in them. Value as a factor has been the consistent outperformer for well more than a year right now. And even in sectors like technology, consumer discretionaries, you can look for, search for, screen for value without having to pigeonhole yourself into the sectors that are only housed in the value indexes. And that goes back to the utilities as an example. Utilities are really expensive. In fact, on some metrics, they're more expensive than the S&P 500. That doesn't make them growth stocks. Russell doesn't move them into the growth indexes because they're expensive. They're just expensive stocks that live in the value indexes.
Exactly.
So it's sometimes called a value trap. Another example I give about this distinction, I always say between lowercase g and v, and uppercase G and V, meaning the indexes. If you were a deep value investor at the end of 2002, after the tech bust had finally hit bottom and Nasdaq 100 had been down 83% at that point, if you were a deep value investor, you wanted to go into the beaten down tech stocks that ultimately were going to be the survivors. That's where you found deep value. They hadn't been all moved into the value indexes. They still lived in the growth indexes, but that's where you found deep value. So when I say focus on value, focus on quality, that doesn't mean, and therefore you're limited to only looking at energy and financials and utilities. You can take a value-oriented approach, a quality-oriented approach, and apply it in sectors where you also have the benefit of getting the growth kicker. So I think that that's really misunderstood, especially in these days of everything being sound bites and not a lot of sort of detail under the surface.
Is that what you mean then by factor investing, is that you are considering value to be more on sale and considering, that rather than the traditional sectors that are lumped into value funds?
Right, because, energy has had just an unbelievable run and the stocks have gotten a lot more expensive.
Yeah.
I already mentioned that utilities and different driver, but utilities have had a big bid under them for years because of the search for yield in a low yield environment. So they become more expensive. That doesn't necessarily make them growth stocks. So when I talk about value, I'm talking about the characteristic of value. And it's not just a low PE ratio versus a high PE ratio. There's lots of ways to sort of screen for or measure value. Some of the most consistent outperforming factors, even when applied to screening within growthier segments of the market, are strong free cash flow yield, strong balance sheets, lower debt ratios, and then also working in some of those growth factors, steady forward-looking earnings growth, positive earnings revisions. So there's a way to screen for multiple factors through lots of programs. We have it at Schwab.
I was going to ask you, do you have some tools that the mainstream
we have, and I'm not,
use?
that's not what not the world at Schwab in which I live on a daily basis, but yes, embedded in Schwab equity ratings. And then even through some of our trading programs, both on the Schwab side and the TD side, there are various tools that you can use to screen. Even some of the, primary websites, I'm guessing, have screening tools, whether
Definitely.
it's, Yahoo Finance or Market Watch. So the ability to actually screen for certain characteristics, I think is more available. The information and access to information has never been better, but it's just a broader message that you can actually look for certain characteristics that give you either good value or higher quality or the combination of value and growth without pigeonholing you in certain indexes. And I think that's important, especially in this environment where so many people have become more passive. And if you are a passive investor and you are investing at the index level, at least I'd say understand what you're buying, because up until November of last year, the Russell 2000 Value Index was beating every other index, beating the S&P, beating all the other Russell Growth and Value Index. And people thought, oh my gosh, why is small cap value doing so well?
Right.
It was two stocks. It was AMC and Avis. It was meme stocks.
Mm-hmm.
That's not a small cap value story. That's a speculative ridiculousness in meme stocks. And two of them that went on fire happened to live in the Russell 2000 index. So also be careful about, the headlines and the narratives. We need to peel the onion back at least one layer to actually see what's going on under the surface.
So I'm going to give you, is there anything that we haven't discussed that you think is really important for your, for mainly Main Street investors to be looking at?
I'd say a couple of things, and these are sort of taglines of mine that I've said for decades. The first one kind of puts a bow around some of the things we've talked about throughout our conversation, Natalie, which is, investing should be, and to be successful is a disciplined process over time. Get out is gambling on moments in time, and investing should always be a disciplined process over time and doesn't require short-term market timing, doesn't require figuring out tops and bottoms. I don't know any successful investor that has done it that way. So that's the first message. And then we're all data watchers these days, whether it's inflation data or economic data, and trying to connect the dots between what is happening in the economy and what's happening in the market. And that certainly was happening during the worst part of COVID, when the number one question I was getting is, why is there such a disconnect between what's going on in the economy and what's going on in the market? And one of the overarching things that people sometimes fail to grasp is that when it comes to economic data or inflation data and how the stock market acts, better or worse tends to matter more than good or bad. Meaning it's human nature for us to look at economic data points, retail sales or job growth or the unemployment rate or CPI, whatever it is, fill in the blank,
right,
and think was it strong? Was it weak? Was it good? Was it bad? But the market tends to key off inflection points, second derivative, rate of change, better or worse, not good or bad. And that's sometimes why investors miss a lot of the early stages of bull markets, is they're looking at the economic data and saying it's absolutely horrific. Well, the stock market has a keen ability to pick out the inflection point, the point at which the data stops getting worse and starts getting better, the bottom of the V. By definition, when you're at the bottom of the V, in a snapshot sense, the economic data is as ugly as it's been.
Right.
The stock market tends to sniff out that that's as bad as it's going to get and moves in anticipation of the improvement. Whereas a lot of investors say, I'm not going to be comfortable investing until it's back to being good again. And unfortunately, you've missed a lot of the bull run. So that's another message.
And you're oftentimes ready to get in, maybe at the top or even
right when the economic
top, right?
data looks the best. The market tends to sniff out that, okay,
all your friends are telling you how much money they made. I mean, I think, and I do want to wrap this up, but I think that we should mention how liquidity, especially with the corporations and the buybacks being so strong last year. Are you seeing that buybacks are going to play a factor again this year? I mean, there's still a lot of cash there, right?
There is a lot of cash. I'm not sure that we continue to break records like we have recently, so I wouldn't expect that to be as powerful a force, but there don't seem to be too many conditions lining up for some, significant implosion.
Right.
Sometimes there's the risk of moves out of Washington to sort of stem that tide, or at least sensationalize it as a bad thing. And that doesn't seem to be on the radar, but I wouldn't expect to continue to see the significant push under the market of buybacks as we saw. But there were lots of other forces at play last year, but I would expect that buybacks are probably set to ease versus continue to accelerate at this point.
Okay. Well, thank you so much for your time. As always,
My pleasure.
lots of great information.
Nice to see you as always.
Nice to see you too. And everybody do visit schwab.com, and the resources. I mean, Liz Ann is a prolific writer. There's a lot of market commentary there, and she really drills down and makes it easy to understand. Thank you so much.
Thanks, Natalie. Thanks, everybody.
Bye.